begin it now? Whom do we talk to? Anyone, everyone, everyone. So serve to change lives, 'cause lives can be changed forever. Serve to change lives whenever we're working together. Talk to someone right now. Start now and wow. When the right time arrives, you'll see you've changed lives. So serve to change lives, 'cause lives can be changed forever. Whenever we're working together, talk to someone right now. Start now and wow. When the right time arrives, you'll see you've changed lives. So serve to change lives.
Good evening, Rotarians and guests. My name is Dasun Premadasa, and I'm your MC for tonight's meeting of Rotary Melbourne. First of all, we would like to acknowledge the Wurundjeri and Bunurong people of the Kulin Nation, and also pay our respects to elders past, present, and future, and extend the respect to all Indigenous Australians present today. Please note that most microphones has been muted for the duration of the presentation. Accolades, comments, and questions can be posted via Zoom chat function throughout the presentation. It is my great pleasure to welcome you to our 27th meeting of the Rotary year and our monthly evening meeting. We are so pleased that you can all make it. It's also my honor to welcome our guest speaker, Emma Hurd, who's a partner for climate change and sustainability at Ernst & Young. And I'm sure some of us got to meet Emma before the meeting, and she will be introduced more fully by our Environmental Sustainability Chair, Gary Fowler. In the meantime, I would like to welcome both of them to the meeting. Also, I would like to remind that our club meetings this year are led by a team of members. I'm waiting for the slide. There you go. So you can see they are led by a good-looking team of members. We plan to have evening meetings every second Wednesday of the month, mid-new year, and we hope to have it in hybrid format. Now I would like to pass the meeting on to our chair for the day, Gary Fowler, to introduce our guest speaker. Over to you, Gary.
Thanks very much. And it's a great pleasure for me to introduce Emma Hurd. Emma is a partner with EY's Climate Change and Sustainability team. You may or may not know that I, for many years, was a partner in Ernst & Young. And in fact, I probably had a similar role to Emma about 20 years ago. So there's a bit of a shared interest there. She's a skilled professional with over 20 years experience in climate change, sustainability finance, and sustainability practice. Prior to joining EY, Emma was the Chief Executive Officer of the Investor Group on Climate Change and the Environmental Commissioner for Greater Sydney Commission back in up until 2021. So she's extremely well known and is a regular media contributor on climate change matters and a respected voice on climate transition implications for business. So she's eminently well qualified to be speaking to us on her subject, which is the rise of ESG. Can capital save the planet? Just one comment before handing over to Emma if you have any questions, can you please put them in the chat function, and then they'll be picked up for a Q&A session after the end of her address. So over to you, Emma. Thank you.
Great, thanks very much, Gary, and it's a pleasure to be here this evening. I'll also just quickly start by acknowledging the Gadigal people of the Eora Nation, the traditional owners of the land from which I'm joining you today around Sydney, and pay my respects to elders past, present and emerging as well. I did pose the title of my comments rather provocatively, because one of the interesting challenges that I always receive is, to put it in the modern vernacular, when did finance become so woke, in terms of actually seeing all of these banks, financial institutions, insurance companies, hardened institutional investors, fund managers, suddenly caring so much about environment, social and governance issues. So I actually thought I would take a little bit of time just to explain or provide some context as to where ESG even came from. Why is it suddenly everywhere? I mean, you can't pick up the paper or watch the news without seeing it reflected in the business coverage. What is it trying to do? How does it work? And then what are some of the really key issues that we're seeing playing out, particularly from an environmental perspective? I would kind of acknowledge that there is the S and the G in ESG, so social performance issues and governance issues, but I'll be framing most of my comments to the environment, or the capital E dimension of this as an area. I did think about having slides. I thought about slides. I thought we're all on so many virtual calls, looking at so much information. Sometimes it's hard to read and listen at the same time. So I went with the no slides policy. I might regret that about 15 minutes in, when I can see on the screen when people have started reading their emails and slightly going to sleep. So I will be randomly increasing the volume of my voice to keep you focused. But also I would very strongly encourage you to drop questions in the chat box. And please, I will not take it amiss if you want to jump off, come off mute with a burning question. I would just notice that we will have some Q&A at the end. But feel free to jump in with questions as we go. I'm more than happy to respond as we sort of talk through some of these key issues as well. So let me start a little bit by talking about ESG, because this is one of those areas where there is a frenzy of acronyms, or a ridiculous amount of terminology, which is all used to describe similar things, but just from different perspectives as well. So, and I'm going to do that through the lens of where did it come from? And I think, if anything, ESG, and as it's often called, sustainability, is one of those classic 20-year overnight sensations. 1 minute it's fringe, the next minute it's everywhere. How did we get here? Where did it come from? So I'm going to give you my potted history of the development of ESG over the last 30 years. So if you think about the growth of the funds management industry, and particularly in the case of Australia with compulsory superannuation and the way that the superannuation industry is established, right from the beginning, from pension funds in Australia, but also in every other jurisdiction, we've had this kind of focus on what are the long-term investment strategies that I need to be deploying? What are the long-term structural shifts or issues or performance dimensions for companies that are going to impact my investment decisions? And in particular, if you think about super funds in Australia, when the average super fund holder puts their money into a super fund, they rarely change, although that is changing slightly. They rarely change funds. 35 years later, on average, they want their money back. And the money that they're putting in at the beginning of their life and the money that they're taking out at the end, it's a very different environment. And a lot happens over that 35-year period. So initially, this all came from this idea of, how do I begin to understand the long-term trends that are going to impact my portfolio, that are going to impact my investment decisions? You also see a lot of investment funds and pension funds investing in long-term fixed assets, so big pieces of infrastructure, airports, toll roads, shopping centres, things where they can deploy what's often called patient capital, money that you put in and you let it earn you a nice, steady, low-risk return over a long period of time. A lot of those physical assets are increasingly being impacted by extraneous events. So if you think about, a pandemic is one that springs to mind at the moment in terms of the attractiveness of investing in an airport, but also things like toll roads and whether they're going to be flooded on a regular basis and how that's going to impact returns. So a lot of the types of things that pension funds are investing in are in industries and are in infrastructure, which is very impacted by broader societal issues. And then thirdly, you also had the emergence of what was initially called sort of values investing. And one of my favorite expressions in this area was where you had particularly a lot of faith-based funds thinking about where do they want their money actually going, and how do they begin to screen out investments in what are often called sin stocks. So you don't want your pension fund, if you're Cushion Super, for example, invested in gambling, pornography, arms manufacturing, for example. So how do you begin to develop a systematic approach to getting your money out of, or ensuring that your money does not go into, the types of economic activities which are not aligned with the values of the members of your pension fund or your super fund? So these were kind of three trends that were bubbling away about 30 years ago. This began to then converge into a more systematic way of thinking about this as an investment discipline. So if you are a portfolio manager, if you are a super fund, how do you do this in a way that's not just the investment committee getting together and randomly deciding on a bunch of issues that they care about? How do you actually do it in a way that is aligned with core fiduciary duty obligations, that is thinking through core trustee obligations for pension funds, that is actually thinking through how do you have better risk-adjusted returns for your members? How are you actually reflecting the cultural and the stated desires of your members if you're a super fund? So they began to think about it in terms of how do you build this into a proper discipline, a proper way of doing it systematically. That's had a few different names. So that has become, that was often called ethical investment. Sometimes it's called responsible investment, but probably the language which we've more or less settled on is ESG. So the environment, social and governance performance dimensions. So that was kind of phase one. Let's all agree that we need to do this and why, and what the purpose of it is, and how it begins to impact returns. The other aspect of it was, I think the last point I would just mention on this is that it's also kind of important to think about it in the context of the fact that traditionally the market capitalization of firms was, roughly 80-20 financials, non-financials. What we've seen in the last 20 years is that total market capitalization for a company, the balance is now shifted. You're almost seeing a 30-70 split in terms of 70% of a company's market capitalization is now based on non-traditional financial factors. It's based on what the market view is of the value of the stock. And that is taking into account performance across a much wider dimension of issues. It's taking into account diversity at the board. It's taking into account ethical conduct. It's taking into account local community relationships. So how do you begin to understand and better model and predict what's going to influence on a future forward basis the market capitalization of a company you're invested in, unless you have a more systematic approach to understanding all of those non-financial issues as well. So this is the last piece of the puzzle, and why do we end up having ESG altogether? This then began the industry's 25 to 30 year journey in terms of answering two questions. What are the dimensions of performance that influence returns? What are the best, how do you measure it? What are the best metrics? And then how do you invest on it? So how do you make informed, ESG informed investment decisions? So from this, we've had the proliferation of a number of things, and I'm not going to go through every different investment technique that portfolio managers are using now, because I think, possibly be asleep in about 15 minutes, but I'm just going to run through probably three main ways in which we think now see investors kind of applying some of these ESG techniques. So the first is very much, as I mentioned before, negative screening. So a portfolio manager or a company takes a view that certain types of activities are going to negatively impact a company and they don't, or a market, and they don't want exposure to them. This is where you begin to see a lot of banks and a lot of investors saying that they won't invest in thermal coal, or they won't invest in companies who don't have 50-50 gender diversity on their board, or they won't invest in, again, as I mentioned before, they won't invest in gambling or arms manufacturing. So this negative screening is you make the policy decision You apply a negative screen across the whole portfolio, and you ensure that you don't have any exposures to those sorts of activities. This is sometimes done for financial risk reasons. You've taken a view that an industry is in structural decline, or for broader values alignment or member-based decisions as well. The second way is positive screening. So you're taking a view that you want to increase your exposure to activities or economic industries that are more likely to be well positioned in terms of some of these broader issues, or who you think are more values aligned. And so you often see, for example, a super fund like Hester, whose members are based in the health industry, has a deliberate approach of investing positively screening for more positively aligned health initiatives, or because a lot of their members are women, because the majority of the health industry is women, they have a lot of initiatives, investment initiatives, which are focused on achieving more positive social outcomes for women. So the positive screening approach is about increasing your exposure to positive ESG issues as well. I would say that for all of the funds, it all has to be on a value basis. It all has to be generating returns. There's no discount for good in the investment world. Everything has to make money, and has to make money for members as well. So you've got negative screening, positive screening. The third approach is about active ownership. And this is where you have a number of funds who've taken the view that, well, you know, and this is particularly true of the big funds, say like Australian Super, Australia's biggest superannuation fund. They take the view that they are exposed to the whole Australian economy. So their view is that they actively engage the companies that they hold to better understand their ESG performance, and to actively encourage the companies that they hold to improve their ESG performance. So they want the whole economy to improve its performance, or their whole universe that they own to improve their performance on ESG issues, because they see it as having a positive, beneficial financial effect for their total portfolio. So this is where you see shareholder resolutions at AGMs. It's where you see companies in the media saying, where investors are asking us about climate change, for example, and what we're doing, or companies saying that they're responding less to regulation around these issues and more to investor pressure. This is the result of this active engagement approach that a lot of investors take to try and manage their ESG issues. And then fourthly, you have specific fund options. I'm sure all of us, you know, if you look at the super fund industry these days, there are multiple different funds that you can put your money in, and you'll see, no matter who you're with, you'll see there's almost always an ethical option, a sustainable option, or a more environmental option, a green option. A lot of them are building funds, particularly to address the stated desire of their members to have your own personal retirement savings invested in a way that is aligned with your values, and to ensure that, for example, your retirement savings is not going into activities that you don't agree with or you don't support, while still generating strong returns. So there's lots of different ways to do it. Some of it is around different motivations. But as you can tell, this kind of basic concept of what are the non-financial factors that are influencing financial performance has now evolved into a whole discipline, a whole complex industry, and a whole set of different kind of approaches. So when the investors start asking companies about what they're doing, then companies start developing ESG strategies for investors. And they start, because obviously most companies are trying to increase their attractiveness to the capital markets and trying to get more investors putting money into them. So you see a lot more companies then beginning to actually say, here are my ESG credentials, you know, putting into their annual report a lot more environment and social information. And then you get the spawning of a whole industry around reporting standards and how that actually works and how you systematize it. So it begins to feed in on itself in terms of, you know, investors want more, companies report more, investors want more. And you have these whole conversations around ESG performance. That's the kind of theory of it. I want to give you 3 specific examples to show what this looks like in reality. And these are all recent examples from the last 18 months to 2 years. The first is Rio Tinto, and the significant changes at the board and executive level that happened as a result of the explosion of Indigenous artefacts at the Yukon Gorge, where Rio Tinto, for the purposes of mining expansion, blew up some Indigenous artwork in caves that were 45,000 years old. This caused a huge shareholder revolt, because it raised concerns about the gap between what the company was saying about its risk policies and processes around preserving Indigenous heritage and what the local site manager was saying around what was actually expected of them on the ground. And it pointed to a broader concern around governance issues around mismatch between policy and outcome in terms of how projects are being managed. The chair and the CEO moved on, substantial change at the board. You know, this is a major global listed company that, because of a social issue and concerns around the governance of the social dimensions of this issue, subsequently saw a huge stock price drop and changes at the executive board level. It's probably not the only factor, but it was kind of the straw that broke the camel's back in a lot of ways as well. That's my example number one. Example number two is AMP Bank and concerns around how the company was managing diversity at the senior levels of management, and in particular claims of sexual harassment and bullying at certain sections of the organisation. Again, investors were engaging with the company, with the board, around how these issues arose, why a company as sophisticated as AMP should be experiencing these sorts of complaints, how it was handling them, how it was dealing with employee issues. The company saw huge employee attrition at all sorts of senior levels of the organisation, stock price tanked. And this is widely seen as one of the case studies of mismanagement of governance performance with a social dimension in terms of how it actually contributed to direct value loss of the company itself. The third example that I want to point to is a positive one, and this is actually on the decarbonisation side of the ledger. So, I mean, as you're probably aware, and I'm going to talk a little bit more about climate change specifically in a second, but as you're probably aware, Australia has a very carbon intensive economy. Most of our biggest companies and most of our biggest industries are very carbon intensive, but there is significant discrepancy in how the market sees how each of these companies within these carbon intensive industry sectors are performing. Now, look to mining, for example. One of Australia's biggest companies is BHP. BHP has been engaged in I would say 10 to 15 year deliberate strategy of diversifying its portfolio of holdings to decrease its ownership and exposure of carbon intensive commodities and increasing its investment and activities in climate aligned, or as they call it, future facing commodities. So this is copper, lithium, potash, commodities which don't have the same carbon emissions attached to them, but are seen as integral to the development of new technologies for low carbon solutions like EVs, batteries, tech stocks, for example. They are very widely seen across the market as a company which is very successfully managing its climate change strategy through a deliberate, and they very actively and aggressively promote their core business strategy as being founded in ESG and particularly climate aligned principles and for the purposes of commercial outcomes. So just three examples of how the theory translates into from the investment community, and the conversation with companies is influencing the things that companies are doing, which is also feeding into the wider national response and international response to some of the big environment, social and governance challenges of our time, including climate, gender equity, and workplace relations issues. So I'm going to talk to the E now, because that's the broader kind of theory, but I want to talk a little bit about the E, or rather the C, which is climate in environment, because it's such a topical issue at the moment and because it is so core to so much of what the finance and the investment community is doing at the moment. So, and in saying so, I want to start by framing my comments with the observation that I think that there is absolutely no doubt that climate change is one of, if not the biggest investment themes of the 21st century. The only one that I can think of which is comparable is digitalization and probably the emergence of Asia. So it's that big, it's that prevalent, it's that economy reshaping in terms of the size of it as an issue. And sometimes it's hard to see that because within Australia, our entire lens of this issue has been framed through the politics of how hard this is for Australia and the political ramifications of some of these issues over the last 15 years in terms of the loss of prime ministers, leaders of the opposition and governments as we've battled our way through the challenging aspects of this particular policy issue for Australia. Personally, I don't think that's surprising, because as I said before, we are a very carbon intensive and very trade exposed economy. The majority of our main economic activities are in energy and finance, which is finance for energy. And the majority of our export commodities are either for carbon intensive activities or are actually carbon intensive in the extraction and processing of them themselves. So it's not that surprising that this is so hard for Australia politically, because it is very hard for our economy to think about how we're going to manage this transition. So that's my note of sympathy for the politicians. But I would just say that I can see someone else's comment in the chat box around the history of decarbonisation. Will it be written by private industry or government? I would kind of make the observation that, say, 15 years ago when we were debating the carbon price mechanism, if you cast your mind back to the glory days of the carbon tax debate, and weren't they fabulous in terms of a shining highlight of Australian political discourse, the carbon tax debate, the expectation was government's going to set the rules and industry will be forced to follow. And what was actually came through was that government did not have the capacity to force change of this scale onto industry in the timeframes it was talking about. The political economy did not enable that. Now we're in and what they kind of realized is that government can't tackle climate change on its own. It needs industry to be at the table wanting to make this change. Now we're in a situation where we've kind of gone the other end of the spectrum, where industry has recognized that for global market reasons, for broader structural issues, they want to push on with making this transition. And actually it's government that can't get to the table. And industry is kind of recognizing that it needs government to be at the table as well to facilitate an equitable transition and a fair transition, and to deal with some of the really tough issues in our economy. So we've kind of gone from here to here, and now we're battling to find our way back to a sensible middle, which is where actually traditionally Australia has been quite good at reform. So I do think that we will get there eventually in terms of managing this. It's just been a pretty rocky road on the way in as well. Who will make the more critical contribution? That's an open question. I think I think both industry and government are under the microscope in terms of who's going to win that race. Critical contribution could also be construed negatively in terms of who's going to behave the worst on the way through, because it's not all roses and sunshine on the private industry side either. We are seeing, as it becomes a lot more real commercially for a lot more companies, we are also seeing some really interesting challenges for private sector companies in some of these key industries as well. Which brings me to the regulators, who've actually played a really key role in the Australian debate on climate change and decarbonisation. And I'm talking here specifically about APRA, ASIC and the Reserve Bank, because I think to their credit, they did realise a number of years ago that this climate change is just as much an economic issue for Australia as it is an environmental issue. And so they really began to use the levers and the channels available to them to quietly, methodically work their way through and explore where does this sit in terms of their core responsibilities. And you saw this series of speeches that came through from key personnel at those organisations over the course of a number of years, starting in the starting in the late 2000s, I think. So APRA first came off the rank under the former executive director Jeff Summerhays, made two key headline speeches where he talked about why climate change presents a systemic financial risk to the Australian economy, and why it was therefore the responsibility of their regulated financial entities, so the banks and the insurers, to begin treating it as a core financial risk with all of the same policies and processes that they should be applying to other key financial risks, like cyber risk is the other comparable one. So they needed to be looking at stress testing their portfolios. They needed to be building a data capability. They needed to be building it into their credit risk policies. They needed to be understanding how their customers would be impacted. They needed to understand the exposure in their mortgage book, for example, around key issues such as climate change. This has gradually stepped up. Then ASIC entered the fray, looking at the massive reporting that was going on across all of the companies, the different industry standards being applied, and some of the more aspirational, shall we say, claims being made by companies on their environmental performance, and began to flag that they would be cracking down on greenwashing, that they actually saw false or misleading claims around environmental performance, as being false or misleading claims to the market on commercial performance, and that they would be pulling up companies who were making some of these more bold statements around their performance. Coming around the other side is a bit of litigation risk on this front. There's a couple of key examples of legal cases. So Rest, the super fund, was taken to court around failing to provide sufficient information to its members around its climate change response as part of its core financial product disclosures, and settled, and then fixed everything and suddenly declared they were in support of net zero. You've also got Santos currently in the courts around claims that they are net zero aligned and that gas is a clean energy fuel. They've been taken to court for that being a false and misleading claim because it's not actually backed with any robust scientific evidence around its actual contribution to decarbonisation, and that's an open case at the moment. So the regulators, and then finally you had the RBA come in, which is the third of the big three, where you had Guy Debelle talking about the structural and systemic issues for the Australian economy of issues like climate change. And the way that he expressed it was that he felt that we had up until now, or up until a couple of years ago, thought about it as a cyclical issue, as in when you had extreme climatic events like drought, it would have a short-term impact on the economy and on GDP as a result of key industries like agriculture, or when you had a mining depression, a similar sort of negative impact on GDP, but then it would work its way through the system and pick up. He said that now the RBA was taking the view that they saw climate as a structural risk for the Australian economy, in that the scale of the global economic and industrial transformation was creating systemic risks for key industries that sit at the heart of the performance of the Australian economy: energy, mining, finance. So these three perspectives have meant that they are increasing their using the, as I said, the traditional levers available to financial regulation to put pressure on the finance sector, to put pressure on their clients and their shareholdings to fix these risks and these issues. So that trend that was set up in terms of investors and banks wanting to understand more about environment, social and governance performance is now being pushed along by the regulators, who see it entirely through the lens of risk mitigation from an economic and a financial perspective. So the final point I want to make, and then I'm more than happy to open it up to questions, is to talk about what's the role of the individual in ESG. Is it all just about capital market structures, portfolio alignment strategies, credit risk issues, etc.? Or is there a role for you and me with our super fund or our self-managed super fund or our own retirement savings or our own banking or insurance relationship? And what I would say is yes, absolutely. In actual fact, for banks, in fact, one of my previous roles, I was at Westpac for 15 years, around the mid 2000s, early to mid 2000s, you began to see this wave of customers writing to the bank saying, you know, why are you lending to these industries that are harmful for my future? Why are you lending to thermal coal? You know, how is my deposit going towards lending to these sorts of activities? Why are you involved in payday lending? So why are you contributing to social misery? Why are you lending to large gambling organizations? You know, justify to me as a banking customer why I should keep my money with you when you are engaged in these activities. You know, for super funds, the same question was, where is my money invested? You know, provide me with more information on the environment and social impacts of my pension fund as it's earning me returns on the way through. Where have you got it? How do you know that the companies that my super fund is invested in are good companies that are, you know, meeting the kinds of goals that I want my money to be doing? And build me a fund option. So build me an option so that I can make sure that all of my money is invested in socially progressive issues or is not invested in fossil fuels. That's probably some of the main areas, or is invested in the best of the best. So who across every industry sector is the best performing in this area, and I want my money to reward them while it's making me very healthy, profitable returns. So this kind of issue of like, show me what my money is doing and the kind of impact it's happening has actually been disproportionately influential than you would necessarily think. And I say that because when I was at the bank, the bank only ever received complaints about 5 things. And actually the vast majority of them were in the top 3. Customer service complaints, fees complaints, and complicated product or personal life circumstance change mismanagement, which is a fancy way of saying you got divorced or someone died and the bank stuffed up how it managed it, basically. But by far and above, it was fees and your run-in with the local bank manager that eclipsed all of the other complaints. Suddenly, in the course of 2 years, fossil fuel lending was number 3. And that actually did get the bank to sort of say, well, what are we doing about this? Because our customers care about it. And customers were saying they were moving banks to other banks that were actually doing something about it. Because the customer pressure is a real thing. And it might seem like a lot of the big financial institutions are monoliths, but they do react and they do respond to these sorts of issues as well. And same with the super funds. Super funds have been quite reactive about this, and that's flowing through to the whole investment industry. So if you think the asset owners at the top of the tree, the super funds, then the investment managers are all competing for their business. And so now it's flowing through the kind of value chain of the finance sector to create more positive outcomes as well, which is not to say that there are not many people who are perfectly happy to have their money wherever it gets them the best return and don't care about these issues as well. So this is not 100% universal, but the trend is all one way. And even if the trend is not about doing good, the focus on risk coming from the regulators is providing that counter pressure and forcing the financial risk managers anyway. So understanding where your money is as being an informed consumer in all of your financial relationships is incredibly important, in terms of knowing where your money is invested, where your deposits are invested. Are there things that your personal financial relationships can be doing to better align with your own values, and to ensure that it's not invested in activities which you're not personally aligned with is really important. I'm conscious of time. I've got a few minutes left. There's questions coming through, so I'm going to just pick up on one of them, and then maybe, given that there's quite a few coming through, and I know we're going to have a little bit of a Q&A, we could also possibly deal with them in the Q&A, but I'll just pick up on one, which is this issue around offsets. And so I want to talk about offsets in the context of what a company is doing to decarbonise. So when investors go to companies, or banks go to companies for that matter, actually, and say, what are you doing to deal with climate change? What are companies actually doing? And I would say that everything can be broadly categorized into three buckets. So they're avoiding, mitigating, or offsetting. Avoiding is basically where you change the way you do things to avoid the production of emissions, either increased emissions or existing emissions. So you change the way you do something to produce less emissions, basically. And that can be as simple as, vastly improving your energy efficiency to avoid electricity-related emissions, or it can be, switching your electricity purchasing contract to a renewable energy power purchasing agreement. So 100% of your electricity comes from renewable sources. Mitigating is the other one. So that's very much around thinking through, are there ways which you can substantively change processes or change your business structure, which again are about reducing the emissions impact of your activities. So that can be sometimes in source materials, so the input materials and the products and services you're building, or it can be in terms of your suppliers, or it can be in terms of the behaviour of your workforce. So these are all deliberately undertaking activities to mitigate your emissions footprint. It can also be sequestration. And then the last one is offsetting, and this is where the carbon offsets come in. The carbon offsets are effectively where you buy emissions avoided somewhere else to offset emissions that you produce. So some people call it an accounting trick that actually on a net basis, it's not actually having a positive impact because you're not, substantively reducing emissions, you're just neutralizing the effect of your emissions. Other people say it's a vital part of the decarbonisation of the whole economy. So for some companies and some industries, it's going to be incredibly hard for them to cost effectively reduce their emissions. So in the interim, they should be reducing the effect of their emissions, so netting off their emissions. And they can build it into business strategies so that they can change their processes over time to reduce their emissions footprint. And then for others, it's also part of the customer solution. So I think you, like me, will increasingly see that it's not just going to be Qantas offering you the choice of offsetting your emissions when you book your flight ticket. It'll be insurance companies asking if you want to offset the emissions associated with your car insurance. It'll be electricity companies, which are already saying, do you want to go the green power option? Do you want to go 100% option? It's telco companies saying, if you bring your internet banking and phone relationship over to us, we'll make you carbon neutral as part of the package to lure you over. Like, the use of offsets as a consumer tool, so that informed consumers, as I was saying before, who want to minimize their own footprint, can build it into their consumer choices around trying to do their best to ensure that as they go about their daily lives, that it's not contributing to the emissions problem, and that they're able to influence the companies through their purchasing decisions. So all of which, as you can probably tell, is quite contested. And is it a positive thing? Is it a short-term thing? Is it a transitional thing? A transitional tool is quite the source of debate. And the last point I would just make on that is it also depends on what kind of offsets you're buying. Like, there is a very big difference between planting trees, which actually draw emissions out of the atmosphere, and buying credits from Russia, which are about avoided industrial emissions, whereby the factory's gone broke and they've just banked the emissions not produced by the rusting steelworks as a carbon offset. So there's a very big difference in terms of the quality and the credibility of the credits that you're buying. So offsets is kind of this generic term, but buyer beware is incredibly important in the carbon offsets world.
Thank you, Emma. I've got a question here from Jim with regards to Santos. The EU Commission has considered allowing gas and nuclear to be considered sustainable. Is this an example of the landscape becoming more complex as we get into the real action of decarbonisation?
Yeah, absolutely, yes. Is the short version of the answer to that. I mean, the longer answer is that this all goes, there's two ways to answer this. This all goes to the whole, is gas a transition fuel or not question. And I'll park that one and then just come back to the second one, which is governments are increasingly setting up these frameworks for how you classify different economic activities as sustainable or not. And there's been a whole massive debate in Europe around the finalisation of the sustainable taxonomy. And it all came down to, is gas in the category of does harm or is it sustainable? And they've just recently said that gas and nuclear energy are considered sustainable because they are less carbon intensive than other forms of electricity generation, but it is still very contested. And it's still a massive political fight. I was going to use a less tasteful word then. It's still a massive fight going on in Europe in terms of the definition. I would just say that this year, Australia and New Zealand are about to begin the design of a sustainable finance taxonomy. So we are about to have that debate as well. And I'm sure that gas will be at the heart of one of those key questions around, is it sustainable or not?
Great. We have a question here from Robert Fisher as well. Allowing for Australia's economic mix, how in your view do we stack up globally in terms of ESG policy and practice?
This is a really interesting one, because there's a view that because we're very carbon intensive and we've had such political shenanigans over the last 15 years, that we are not as advanced as our European or North American counterparts when it comes to ESG performance. But I think that the opposite is actually true. We don't have the same supportive regulatory frameworks as Europe. We're not as regulated as Europe actually across the board on everything, but it's also true in ESG. But from a industry practice perspective, many of the global ESG leaders are actually Australian financial institutions. And I think there's two reasons for that. One is that the lack of regulation has meant that industry has had to do it anyway in order to stay in step with global industry developments and a genuine identification of the risks. But also, secondly, the Australian super industry is going through quite an interesting period of transformation. So, because of compulsory super, we're now something like the third or fourth largest managed funds industry in the world. So there is a huge amount of Australian capital, which is now increasingly going offshore and investing in Europe and Asia and North America into jurisdictions that are more regulated around ESG issues. So they're not going to have ESG regulations for one market and not for another. So they're just raising the bar across the board in anticipation of this going global as well. So that the growth of the industry, coupled with proper identification of the risks and the fact that the whole industry is moving anyway, has actually meant that the Australian financial services industry in particular is very, I would actually say, pretty leading on this in this area. Just don't tell them I said that.
Just to tie into that in relation to self-managed super funds, question here from Peter. Most fund managers have one or two sustainability funds, and sustainability funds make up only a small portion of the stock indexed exchange traded funds that are available. Yep. Can the SMSF then assume that in most managed funds and ETFs that ESG investing will actually be occurring? And Peter's comment is it's not obvious that this is happening.
Yeah, that's actually an area, I would agree with that comment. I think this is an area where there's more work to be done. On the ETF front, there's an interesting trend happening whereby you've seen this is kind of, where you've got fintech plus ESG coming together and particularly targeting millennials. So I'm sure many of you would have seen that millennials, every younger generation more likely to be more progressive on a lot of issues, not always, but often. Very focused on ESG and sustainability performance issues. More likely to be involved in electronic share trading platforms and more likely to be actively engaged in thinking around managing their own money rather than just putting it in a super fund. That's why the super funds are fighting so hard to get this younger demographic to join them. You've also seen the emergence of a number of funds like Future Super or gender-focused super, which are actually just ETFs, but their entire algorithm is structured as being all about the screening out. So they apply negative screens and positive screens. So it's like, put your money where your values are, go with, Future Super, for example. And it's actually, but the downside of it is that they have, because they're an ETF, they have high fees. So this kind of interesting trade-off that you're seeing around ETFs piling into ETFs and ESG, it's acronym soup, piling in there because it's where the future of the market is, but you have to look quite closely at the actual other factors related to the performance of the fund as opposed to just the ESG credentials, because they're not always as robust, which is no comment on Future Super, just in relation to that segment of the market. For self-managed super funds, I think there's a lot more work to be done, and I suspect that as a sort of sub-industry, a lot more guidance that could be developed for helping people who want to manage ESG performance in their SMSF to do so as well. I think that's a genuine gap there.
Great. We have a question here from Abaz. Says, thanks, Emma, great presentation. Was just wondering if there were any strategies that are being implemented by private or public organisations to reduce the carbon footprint of their respective employees at an individual level. And so that includes the example of whether employees could earn credits perhaps when they're commuting to and from work using a more sustainable method.
Yeah, that's a good question, actually. I mean, I've seen companies offsetting the emissions of their employees on their behalf. And that often includes the commute, but not always. In fact, the interesting challenge has been, how do you calculate working from home? Or how do you deal with the emissions footprint of people working from home as well for the last couple of years? I haven't seen a reward system. I mean, a number of reward employees have internal employee benefit schemes that do include, they include a number of relationships with preferred suppliers where you get discounted access to goods and services. I've seen a number of organisations that have included in their relationship with carbon offset providers, where they'll you can work out your carbon footprint and you can get a discounted rate thanks to your employer and access to the actual carbon offsets. And similarly with solar panels or other sorts of household related environmental efficiency upgrades. But I haven't seen it on a reward system like that. I think it's actually a pretty clever idea.
Great. One last question from David. Is there a movement here like in New Zealand for companies going beyond net zero?
Yeah, I mean, good on New Zealand, right? They're always a bit more progressive than Australia on this front, although possibly...
The well-behaved cousin.
Yeah, exactly. We're a little bit rat baggy for our region, I think. Yeah, there is, although it's not really about, there is, so it is called, there's a couple actually. So there's the Climate Leaders Coalition, which is basically mirroring the New Zealand version, which I think is actually called a variation of Climate Leaders Coalition. I just can't remember the exact name at the moment. And then there's also another one, which is the Climate League, which is a bit more finance focused, which is about actually setting 2030 targets. So rather than 2050, they're actually looking at, well, 2050 is the goal, but what are we going to do right now? So how do we set a 2030 target, which is going to put us on the right pathway? So there's also a coalition of companies who are focused on a more short-term goal.
Great, thank you. I will just add by saying that I work for AFCA, the Australian Financial Complaints Authority, so I'd be interested to see, and I'm in insurance, so I'm interested to see in future if we start to see those types of, I don't know if we'll ever get jurisdiction in terms of complaints around, you know, where insurance companies are investing premium funds, you know, like, like what you mentioned about fossil fuels. So
I would also be interested to know that, actually. Feel free to share when you get the answer to that question.
Yeah, absolutely. Thank you for that. I'll now pass it on to Dustin for our vote of thanks.
Thank you, Sana. Well, Emma, thank you very much for a very informative session and also answering all those questions from our members and guests. And we have something special for you, and we hope that you like fancy socks, because we have our very own special limited edition R100 Centenary socks, which is 200% Australian made. Well, the script says 200%, so I'm not going to argue that. And it's made right here in Melbourne, in Preston, by our past president, Phil Endesby's Wilderness Wear. So this will be posted to you very soon. And again, it's lovely to have you this evening. So thank you very much. So for the closing and for the club notices, I'm going to pass it on to President Reg. Over to you, President Reg.
Very good. Thank you, Dustin, and thank you enormously to the evening meeting team as well. I have just a couple of notices. Firstly, for Rotary meetings, from next week we'll be endeavouring to resume in-person meetings at number 35 restaurant under the COVID safe practices of the Sofitel. Please join us, and but please do ensure you book ahead in order to determine and confirm catering. Quite a big deal in the club every year is our annual Rotary Melbourne Young Achiever Awards. The club's selection committee is calling on members and friends to consider nominating an exceptional young Victorian for recognition in 2022. The Rotary Club of Melbourne Young Achiever Awards recognise and honour up to 3 outstanding young Victorians annually with an annual award and a cheque of $1,500. Awardees are invited to a luncheon meeting where a cheque and a certificate of achievement is presented, and we hear a little bit about the things that have helped them accomplish in many cases enormous amounts at such a young age. If you know of any persons who may qualify for the award, please discuss this with myself, Iqbal Rita, Mark Laser, or other members of the Vocational Service Committee. A critical criteria is that they must be a resident of Victoria. In 2022, the awards are expected to be presented in May. Nominations are asked for by the 18th of March 2022, and our website has a lot more information. And actually there's a third announcement which I think is very important as well, and this is related to the Rotary Foundation Global Scholarships. The Rotary District 9800 has designed a targeted postgraduate scholarship to focus on overseas studies for master's degrees for participants up to a value of US $60,000. It's not a trivial amount. The scholarship is designed to enhance the profiles of our best graduates in recent years and acknowledges the underlying strength of Victorian university graduates. The field of study must fit one of Rotary Foundation's 7 areas of focus, of which, of course, environmental sustainability is the latest and one of the most important in many of our minds. Applications are invited from persons normally resident in Victoria and must be made through the through a Victorian Rotary Club, hopefully ours. Lineal descendants of current or recent Rotarians are unfortunately ineligible. Applications close on the 31st of March. Inquiries to our member and star recruiter of scholarship winners, Bob Fells, and I'm sure if people wanted to talk to the International Director, Carol Bond, she'd be happy to answer any questions as well. And now in closing, I would like to firstly say a huge thank you to Emma. That was an unbelievably informative presentation, and you approached the task with good humour as well. Emma, thank you. Very enjoyable but incredibly informative. Thank you. And I know from all the comments I'm seeing in the chat that you've been extremely well received. A reminder that our monthly evening meetings will continue every second Wednesday of the month. Our next one is on the 17th of March and is really going to be, I reckon, a bit of a blockbuster, because we're bringing in an eminent financier, Jim Rogers, who will be zooming in from Singapore. Emma's topic, investing and creating business in the post-pandemic world, is likely to be incredibly interesting, and I'm told he's a speaker that thrives on an active Q&A and will deliver very much to the questions that come to him from our audience. So please pencil this in and plan to be there. It's going to be a terrific meeting. Next week's Rotary Lunch will be in person and Zoom broadcast. It's casted in a hybrid format from number 35 at the Sofitel. Unfortunately, our advertised guest speaker, Brendan Gale, now has an interstate commitment and has had to postpone his appearance. We're going to try and reschedule him within the next 6 or 8 weeks. We will confirm a replacement speaker as soon as possible and will alert members of details. Bookings via Humanitics for the meeting will be essential, of course. I hope you can you can join us. Thank you, everyone. Thanks again to Emma. I hope you enjoyed the R100 socks. They're quite a treat, Emma. I'd then therefore now like to say goodbye to everyone, and do stay safe. And for our close, we always try to put on an appropriate music track. This time I close the meeting with a classic environmental song delivered by, backed by popular demand, featuring Paul McCartney, Sean Paul and Natasha Bedingfeld singing the love song to the earth. Thanks everyone for being here. It's been great to have you, and I hope you enjoyed this closing video. All the best, everyone.